Hi all, welcome to Share It Today. Record to report entries during an interview. The first one is meaning of accruals. At the end of accounting period, you need to accrue for expenses that have been incurred but not recorded. So the entry would be expenses account debit, accrued liability. So accrued liability, you have to book it under current liabilities. So for example, how would you record an accrual of 5,000 of utility expenses that have been incurred but not yet been paid? So you have incurred an liability in the month of August, but you haven't paid it. So you'll be paying this in the month of September. So the entry will be utility expenses account debit to accrued liability. So utility expenses is the expenses which goes into P&L, profit and loss account, as well as accrued liability. It will go under the liability, current liability in the balance sheet. So the second one is prepaid expenses. So a company pays for an expense in advance, such as insurance or rent. So the entry for that, prepaid expenses account debit to cash or bank. For example, how do you record 12,000 payment for 1 year of insurance coverage paid in advance? So that means you have paid an insurance of 12,000 in advance. In advance in the month of August, which belongs to September. Okay. So you have to book this expenses in the month of August. The entry goes as prepaid insurance account debit 12,000 to cash. But why this is not an insurance account? Why this is an prepaid account? Because prepaid account, if it is an insurance account, it will go into a P&L. But the in profit and loss account, it's the expenses is not belong to August. The expenses is for the month of September. So it is already prepaid. We have paid prepaid. Okay. So prepaid insurance account debit to cash. So the third one is accrued income. It is an income which has been earned but not received yet by cash or bank. Understood? So like service has been provided but not received cash, goods sold on credit. So that means you have provided an service but you haven't received a cash. You have sold an item but you made a sale but you haven't received a credit. You have received the cash. Okay, so that means goods sold on credit. For example, how would you record 15,000 sale on credit? So there is a sale. You have made a sale, but you haven't received cash. So the sale is made on credit. Okay. So if you have received cash, the entry would be cash account debit to sale. Got it? So, but you haven't received cash. So you have to debit the accounts receivable. Account receivable is an asset account. Okay. So which goes into balance sheet. And the sale is profit and loss account. So the next one is deferred income or unearned income. It is called as deferred income as well as unearned income. Income received in advance but belongs to next period. So the meaning itself says you have received an income, you have received a cash in advance but belongs to next period. So the client has given us money in advance in February month wherein we rendered a service in the month of March month. So that means you have received a cash. So cash account debit to unearned income or deferred income, which falls under the category of current liability. Okay. So the fifth one is depreciation. So it is a recording the periodic depreciation of a fixed asset over its useful life. So the entry is depreciation account debit to accumulated depreciation. For example, if a company purchases equipment for 50,000 with a useful life of 5 years, how would you record the annual depreciation? So the entry would be depreciation account debit to accumulated depreciation. So depreciation goes in a P&L account and the accumulated depreciation goes into balance sheet. So the sixth one is reversing entries. At the beginning of new accounting period, certain accrued or deferred entries are reversed to avoid double entry. So for example, the entry would be accrued liability account debit to expense account. Why do we reverse accruals at the start of the next period and how is it done? To avoid double counting expenses or revenues in the next period, you have to pass an entry, accrued liabilities, the same amount as the original accrual, to credit expenses account. When you are booking an expenses, you have already seen over here, right? When you're booking the expenses over here, see, when you're booking the expenses, it's expenses account debit to accrued liability. So when you're reversing it, it will be accrued liability account debit to expenses. So the seventh one is intercompany transactions, recording transactions between two entities within the same corporate group. Okay, one entity would be selling and one entity will be buying. One company will be selling it. So you have to debit the intercompany receivable because they are the receivers. Credit to revenue. For buying entity, it is an expense. Okay, because they are buying. So expenses always debit. You have to debit it always. Expenses account debit to intercompany payables. Thank you very much. So in this video, we have covered the topics accruals, prepaid expenses, accrued income, deferred income, depreciation, reversing the entries, and intercompany transactions. Thank you very much. Bye bye. Let's go together.